With a lot going on with the markets themselves, I want to give a brief update. Now, I'm going to try to keep this pretty brief, but there are a lot of slides here and just to highlight some of the different aspects of what's going on with the markets. So let's dive in. And this is a second quarter update, but it's going to be quite short comparatively just because we're already halfway through the quarter. So again, we here at Lions Wealth help to create an impact for you, your family, and your community through a well-defined wealth plan. Let's dive in and let's start talking about some things here. First of all, the quarter-over-quarter GDP is something that we are continually seeing deteriorate. When what we're really seeing now is the fact that we had some good growth coming out of COVID, but that's really started to materially decelerate and start to go negative here this particular quarter. So this is not great when we're really taking a look at the overall health and well-being of our economy. And the more that we have these negative numbers, the more this shows that we have a recession. Now, whether we're in one or not is something that we don't quite know yet, but it's going to be something that as we take a look back, most likely we'll see that it's been over the last month or so that we probably are in already a recession. So that's going back to our GDP here in the economy. Now the world looks about the same where we have a slowing of growth, and we're going to be talking about that as well. But also we see here that we have a slowing of inflation. And this is exactly what the Federal Reserve wants to see, the slowing of inflation. But here's the thing. You can see the blue lines here that really what comes back down are the projections of the future. And this is the mathematical, most likely probability of where we're headed on a inflation front going forward. And the problem is that's not coming down fast enough for the Federal Reserve. And with the jobs where we're at with respect to, we have lower unemployment than what we generally have in the cycle of the growth of our economy, or a lot of different aspects here. Inflation is going to be probably sticky high compared to maybe this time in other historical cycles. And that's a really bad thing when it comes to what's going on here. And what we can really start seeing is that, yes, the CPI, the inflation numbers are coming down, but since they're not coming down fast enough, what we're already starting to see is the fact that the Federal Reserve needs to either keep raising the interest rates in order to keep this coming down faster, or they're going to have to hold it here for longer. And the fear, and this is actually a really big fear, is that let's say they do the opposite. Let's say they actually start cutting interest rates to start stimulating the economy again to get that going. Well, that could really start to affect inflation and have that start to skyrocket back up. And Jay Powell, our federal chairman, really knows this and is trying to thread the needle here a lot more. And so when we take a look at the data here, and this is what we call the Nowcast model, and a lot of these numbers are put together from Hedgeye Risk Management, and they do that. They look at all the different data points, and this is where we come up with the differences of the inflation, the differences of where we're headed in the economy, and then what that means for you as looking at the investments. Now, as you can see here on the left side of this, and this is looking at 30 different types of really fields of the economy and different outputs of the economy. And on the left side was going back all the way to 2021, and you can really see that we had a lot of green, a lot of growth that's happening. And now we're fast forwarding to today on the right side, and you can see things are getting a lot worse. So the more red and the darker the red that we see means the more likelihood that we are actually experiencing more negativity in the economy. So that puts us squarely into what I call the lead 4 category. So that's the Lions Wealth Economic Activity and Development category, stage 4, where we have a slowing of growth and a slowing of inflation. Now, generally speaking, you would think that that would be a good thing, that we have a slowing of inflation. Well, in this standpoint, is actually directly related to basically people stopping of the spending habits that they've been doing. So the consumer is not spending as much. And you can see this when we take a look at Target versus Walmart. Target is seeing a significant slowdown in a lot of their purchases, and people are trading down to Walmart for some of their shopping. And Walmart is even seeing a huge amount of slowdowns happen, albeit in groceries. And groceries are something that's starting to increase in pace because of the fact people aren't eating out nearly as much. So there's a lot that's going on here. And right now what we're seeing, we're calling this a sinkhole, because as sinkholes form, it generally is something that over time that you can see from the base that it's starting to form. And we don't see it on the surface level until it really starts to get bad, and then everything collapses in and on itself. And why this is really indicative of where we're at right now is that underneath the surface of the stock market itself, basically we have a number of different companies. And it depends on which index you look at, whether we have just 30 companies or 500 companies or 2,000 companies or 3,000 companies that we're taking a look at. But what we're actually starting to see now is that there's only about a handful, about 5 to 6 companies that are sustaining the entirety of the stock market right now. And the rest of the companies are actually starting to really go down in value. So if we're taking a look at the individual companies, there are many that are not doing well right now, while there's a couple that are holding up this sinkhole type mentality. So that's exactly kind of the thought process of where we're in. And I've shown this chart before, but it really comes back down to that we do not have a lot of liquidity in the stock market right now. That's just something that we're really starting to see because the Federal Reserve is pulling money out of the stock market. Well, that actually is heightening some of the volatility that we're starting to see. Well, that actually starts to lower the prices as well. And you can see this cycle start to perpetuate. And yes, we are seeing prices really stabilize over the last couple of months a little bit. We've been in kind of what we call the sideways pattern for many months now. But when we take a look at everything here, we take a look at what's going on with liquidity, what's going on with the different stocks that are making up the stock market in general, things really point to a different picture. Now, I talked about how many stocks are holding up the stock market, and this is a huge example. And this again was done by Hedgeye Risk Management, one of their graphic designers, and also they have an on-staff cartoonist, and he does a great job of trying to just take a look at all of this together. And what we're seeing now is there's the highest basically relation in history of two stocks holding up the entirety of the market. So now, cumulatively, Microsoft and Apple make up 15% of the S&P 500. And many days now, they're making up 100% or more of the gains in the stock market. Just those two companies. So you can start to see why we're calling this a sinkhole, because all of the other companies are not doing well right now. It's only a couple of companies that are holding up the entirety of the stock market. And when we take a look at just Apple in general, what we're actually starting to see here, the left side is the historical, and then the right side is much more compressed into the last couple of years. And again, the graphics are something that is nice to see, but also is a little cumbersome when it takes a look at, when we're trying to actually visualize it here. But let's take a look at the right. The black line is the Russell 2000, so small companies. The red line is the Apple stock itself as a cap weight, the how large it is. And for the first time in history, the entire size of Apple outweighs the entire size of all of those 2,000 companies in the Russell 2000. So collectively, Apple is more and valued more than all of the Russell 2000. And that is really a precarious place to be, because under healthy circumstances, this should not happen. But what ends up happening is people are starting to sell off some of these other smaller companies, and the values are starting to go down, and then buying Apple as what we call a safe haven. But because of that, again, that's keeping Apple up and higher in the price point, And we don't know. I mean, maybe it's going to be sustainable, maybe not. But if we're taking a look at what this actually is with a single analogy, if Apple has anything that happens to them and starts to roll over, we could see some huge issues crop up with the stock market itself. So let's take a look at some of the things that we're taking a look at here and the reasons why we've been very kind of pessimistic on the overall stock market and the economy itself. So first of all, when we take a look at January, you can see a lot of things that have actually helped basically happen pretty well with some growth happening in the goods of our economy. But since then, we've peaked and started to come back down. Now, this was a seasonal type of a thing as well with respect to Christmas and some of the other aspects that there was a lot of replenishing of stock that happened. So goods were coming up, but now they started to roll back over and start to head down. So that's a very crucial element of things that we're starting to see. Then we take a look at manufacturing, and we had this huge boom in manufacturing when we were starting to purchase a lot in 2001, 2002. Well, again, that has rolled over, and that is not good for our economy as well. Then we look at capital expenditures of the companies themselves and the money that they are spending to help improve their overall manufacturing plants, marketing related expenses, anything that's actually going to improve themselves as a company. And they're pulling back on that expenses and those spending. So that's less spending, less liquidity that we are talking to and talking about there as well. Well, then we have the real income of the individuals themselves. So this is really starting to say that income, the real income, what that means as a inflation adjusted, is incredibly, well, diminished from what it used to be. And now we're in 25 consecutive months that the growth of inflation is outpacing our wages. And so it is habitually starting to feel like we have less and less money every single month. And that is really what we're starting to see now, and why people are starting to trade down, because they can't afford the things they used to be able to, because things are getting more expensive with inflation. Well, the other aspect here that we're starting to see is that because of that, people are putting more and more onto credit cards. So the balances are starting to creep up, and that's what is showing in the left-hand side here, is that we're growing at some of the fastest pace in history. But then if you take a look at the right side, that is the average interest rate, and we're starting to see that grow at some of the fastest points in history as well. So not only are the balances increasing, but the interest rates that we're paying on those balances are increasing, and that's a very negative place to be. Well, here's a kind of another aspect here, that usually it's credit card debt that's paid down because of Christmas and right after Christmas. But that really has not been the case this year. And so yes, we're seeing some green shoots a little bit, but for the most part, there is an incredible amount of credit card debt that was unable to be paid off from the end of that Christmas and December period till today. And that's, again, a really bad place for us as the consumer. Well, then we really start to see that credit itself is really starting to tighten up, and there's a lot of things that are happening that is going to cause us to really not be able to pay our bills and become what you call delinquent. Now, this is especially in about the bottom 60% of the US economy is feeling this pain much more and unable to pay their credit card bills, which means that there's going to be a lot more 60-day, 90-day late payments on credit cards, which means that people are really starting to feel the pain of inflation. Well, then we start to take a look at the fact that the consumer is not in great shape, really. And we're really starting to have a lot of foreclosures of houses start to crop up, as well as autos themselves. So again, this is all culminating and highlighting the fact that there's a lot of pain out there. And if we are really a service-based economy and a consumer-based economy, and the consumer is not in that great of shape, that really is starting to be a harbinger of what's to come. Now, when we take a look at financial conditions, they're really starting to tighten as well. And our confidence in the future is really getting to be all-time lows. So again, when we're confident, we spend money. When we're not confident, we start to pull back on our spending. Well, again, that's us as a consumer, but companies are not doing that as well either. I mean, the fact that they're choosing not to purchase more inventory. And that's because of the fact that inventory is money. And if they don't have the sales to sell that inventory, why would we want to be purchasing more inventory? So you're going to start seeing some dynamic shifts in companies and how much they're purchasing. So if the consumer is not doing as well because we're slowing of our purchases because of the fact that we are servicing debt that we've already had, that's one thing. But when companies start to do that because no one's buying their goods, that's a whole nother manner altogether. So yes, inventory can reverse, and we've had this massive spike recently because of the fact that we need to just replenish things. But now that we're starting to see this rollover again of the expenses and how ways that companies are purchasing new inventory. And yes, because of that, inventory is higher because of what we've already purchased. And if we are not purchasing them, that inventory, whether on a consumer front or on a business front, that's going to lead to higher inventories, which is actually going to hurt overall profits. Because remember, that's where money is tied up right now. Well, let's take a look at something else here as well. Let's take a look at housing. Housing is actually going to be a really, really bad place to be because no one is buying a house right now because there are no houses on the market, and because of the point that we have high interest rates. And so there's a lot of people that are locked into around a 3 to 3.5% interest rate that may want to buy a new house, but they can't because they're going to go from a 3 to 3.5 all the way up to a 7% interest rate, and they can't afford that. So there's a huge need for houses, but there's also a way that there's a lot of different things that are happening that people are unable to now afford the houses that they want and need. Well, that's been a huge issue. And again, coming back to the services, when we take a look at restaurants themselves, they're starting to roll over with respect to the data and how many people are coming to restaurants. And certain areas are doing better than others. So if you take a look at some sections of the city, well, maybe those areas are still doing very well. But then when you take a look at others, and you can really start to see that maybe there's actually 1 or 2 people total in there for dinner. That's when you can start to see the differences that are starting to crop up with respect to service industry. So that's really starting to diminish. And then again, what we've been talking about here is we can measure liquidity in the economy based upon our money supply and how much money is out there. And with the Federal Reserve and what they're doing in tightening this money supply, we have decreased at some of the fastest in history of our money supply. And given the fact that that was what really has been growing the stock market from 2020 through about the first part of 2022, it really is going to be interesting to see when we take all that money out of what actually happens going forward. So this is now the chart of the day. So if you hear nothing else that I've said, this is exactly the chart that I want you to pay attention to. Now, this one itself is based upon the debt ceiling, and the debt ceiling is quite a debacle right now, is I guess the best word to describe it. And it doesn't matter what side of the aisle that you're on, there's a lot that's riding on this. And whether we want spending cuts, whether we want other sorts of concessions that are coming up to make sure that we can be just getting through this debt ceiling and then be able to move forward with our economy, it comes back to what happens when we get this solved. Now, obviously, there's going to be some huge hardships if we do default, yes. But what happens when we actually have it coming together and we have a debt ceiling that's lifted and all the different aspects happen? Well, up until now, and this is really what has been kind of creeping up the stock market and holding it up, I should say, that sinkhole kind of analogy, is because that even though we're raising interest rates, even though we're trying to pull liquidity out in one side, the Treasury has actually been stepping in trying to pay our bills. Now, how can they do that? Well, they're going in and they're actually taking some bonds from other financial institutions. So a lot of public pension funds, things like that, that they can be doing some finagling of things right there for all the different ways that they can be using IOUs to pay others. And that's how we've been funding our bills for the better part of 6 months. Well, we are unable to do that here in probably the first part of June. Now, because of that, obviously, that's provided liquidity into the stock market, and that's really what's been holding us up. But when that stops, actually you can start to see this happen, and we're starting to see on the top line here is the fact that we have that amount of bonds really starting to come out, and the lower line is the liquidity. Well, now they're going to start to diverge, and you're going to start to see the liquidity come out of the stock market here the minute that we have a debt ceiling resolution. But also, that has been a historically bad time for the stock market. So there's still a lot of things that are going to happen because of a debt ceiling resolution, not because of the debt ceiling itself. So there's risk in the debt ceiling that we don't resolve it, but there's also risk for the stock market that we do resolve it. So there's a lot of different things to be looking out for here. Now, we go back to labor. Yes, labor is starting to kind of show its age a little bit. We're at some of the lowest unemployment in history again. But what's starting to happen is that may start to tick upward a little bit more. And when we start to take a look at other areas that are really pulling back on exports, and some of the best ones that we can consider canaries in the coal mine with respect to South Korea and Taiwan for not only semiconductors, but also a lot of different electronics. And you can start to see those exports really start to tank. Well, then we start to really see that this is not just a US thing. This is a world kind of slowdown that's occurring. And that's why we say we're in that lead 4 stage. Now, again, global lead 4, this is the trade volume. We're starting to go negative, and that's not a great thing. Then we start to take a look at the fact that we're just starting this rate cycle here of the tightening and what that means for playing into the markets. So the fact that we're just starting, generally this takes years to play through, not months. Well, if we take a look at other cycles in the past, we really start to see that we have really the differences between the margins of companies and what they're paying in labor costs. Well, that's usually the fact that we can pay more in labor costs, but then what's really started to happen over the years, in just the last couple of years, is that the margins of companies are getting higher, and the labor costs are either staying the same or going down. So we've seen this reversal. And generally in a recession, you're going to start to see this widen out again, where the margins of companies come down. And the margins are really what drives a lot of the profits and what drives the stock price. Because the stock price can be kind of the profits that they earn, plus, so that's kind of the earnings, and then we give them a multiple. And that multiple, even if that stays basically right where it's supposed to be, it never comes down. Well, if we are earning less than per every share, then that means that stock is worth less today than what it was yesterday. And that all comes back down to margins. We have a lot of geopolitical risks. We have a lot of things that are happening. And again, I do think that this is going to be a sticky high kind of inflation environment that we're going to start being in. So that's why we're calling this the sinkhole environment. That's the reason why there's really no change in the thought process here, that there's still a lot of risks that are out there. And yes, what this shows here, that little dotted line on the left-hand side there that's going up, that's pretty much the fastest in history that we have been creeping up to this level of our interest rates. And we don't know how that's going to be affecting the stock market, because this takes time to play through. So whether it's the economy or whether it's the stock market, we don't know quite yet. But we also know that other times in history, whether it's 1990, that we had a recession because of that, whether we had the dot-com recession, we've had the GDP really start to slow down here, and that is in 94. We've had the financial crisis that we had back in 2008, 2009, and we had 2018. Now, if we don't really remember 2018, that was the time that we had that really, really bad December, where we dropped about 20% in the matter of about a month coming into December 24th. And it really was then that Jay Powell said, whoa, I'm going to make a pivot. And we're going to stop all of this and really start to put money back into the system. And that was called the Jay Powell's pivot. And that's where we're at today, that everyone thinks he's going to do the same thing again. And he keeps saying, no, that's not what I'm going to be doing. So there's, again, a lot of risk that's out there. Well, this is also starting to be really interesting as well. You can see that we've had a lot of bank failures happen in 2023, and the cumulative amount is actually bigger than 2001, 2008 time periods of how, on a capital basis, how much these failures actually meant. So that's quite interesting when we take a look at all the different dynamics that are starting to occur. So again, this is just the lending, and we see that, and I've highlighted this before, but just the fact that lending of banks are starting to be less today than what they were because of the fact that they're having some stress of their own. And this takes years to play out. So we're going to see this for the next number of years, potentially, that we're going to start seeing the fact that we don't quite get as much in lending for not only for you personally, but also for companies and corporations. And bankruptcies are starting to really start to go up. So that's, again, another sign of some stress that's out there. So that's kind of where we've been. Talk about the banks really specifically again. 5 of the largest banks happened, largest bankruptcies of the banks happened here. And this is going back into 2000. And this was right after they paused interest rate hikes and started to actually cut interest rates. And right now, Jay Powell is saying he's going to start to pause the interest rate hikes. So that's a huge kind of issue as well. We see the same thing that's happened in 2008, 2009, that 7 of the 20 largest bankruptcies that happened were in that period of time as well, when they paused and then started cutting interest rates. And right now, we're starting to see that cumulatively we have these massively large bankruptcies that are starting to come out, and we haven't even started to pause or cut interest rates yet. So these are all reasons why we're still trying to be a little wary of what's going on with the markets. Now, personal savings are starting to go down, so that obviously is bad for the consumer. And then you also start to see the fact that we're supposed to be in this great environment for hiring, but Ziprecruiter, one of the major platforms for hiring individuals, they're down almost 20% year over year on their profits. And basically what they're saying is they've never seen an environment like this before, and they have this has never been observed. And that's a huge red flag when we're supposed to be in this best environment for jobs, and the ones that are in charge of making those connections happen are starting to say this environment is really odd, and it's something that we've never seen before. And there's no historical precedence for what's going on. So we have to take all that into account. But then we also take a look at all the SNAP benefits. So this was something that people got, the ones that are on food stamps, got extra money during the pandemic. Well, all of that is rolling off. So that is going to be a huge burden now that they're going to be receiving less money for food stamps, but the price of food continues to keep going up. Well, then we also have the fact that we have student debt repayments set to resume here in the next couple of months, and on average that is about almost a $400 a month payment that these individuals are going to have to start making. And because of that, now we're going to see people unable to go out to places like Chipotle or Sweetgreens or some of the other places that these individuals really like to go to. So you're going to start to see a lot of companies really start to feel the pain of the fact that these individuals don't have the money the way they used to because they have to start repaying their student debt. Well, that means obviously a higher debt that they're going to have to service, and that really means more credit card delinquency rates, unfortunately. So we're starting to see that more and more start to happen. And then one last aspect, going back to the debt ceiling itself. It seems like a relative calm manner out there today. But when we take a look at the behind the scenes, we are at some of the highest points in our history for what we call credit default swaps. Now, this is insurance that you can buy to basically on a country level in case the country defaults. And you can see here that back in 2011, we were at 64. Today, we're at 72 for our point of those credit default swaps. So what this is really saying is that there's a greater likelihood that we could default on our debt, and that we're starting to take really buying insurance to try to offset that. Not a good place to be. Well, yes, stock market and equities usually wait till the very last second before they have their sell-off start to occur when things like this happen. So if we go back to 2011, when the last time this happened, that's why we're highlighting these time points. It really was the week of that this really started to affect the stock market. And right now, I would definitely say it hasn't had much effect, and there hasn't been much fear that is palpable out there, albeit those credit default swaps and things that are starting to creep up more and more. When we talk about what's going on with our country, with the debt ceiling, the credit default swaps, this is a huge chart that has really never been seen this way before, that these are the banks and the pain the banks are starting to feel, and what we're starting to see is the losses that are stemming to the bonds that these banks are holding. So this is why the banking sector is not doing well. So if we're seeing the government not do well because of their bills in the debt ceiling, we're seeing the banking sector really having some huge losses. We're seeing the consumer have some huge losses and putting more and more on credit cards. That's exactly why we're saying that we're in this lead for environment, the worst of the worst, and the reasons why we still need to be more risk adverse at this point in time. Okay, well, that's really what I wanted to let you know, but let's just highlight one piece of difference here. Let's take the opposite side and say, if the stock market continues to keep going up, it's actually going to be a self-fulfilling prophecy that as the stock market goes up, more people are going to start to feel FOMO, the fear of missing out. So even with all this risk, they're going to start to buy in. And then what happens is that more people are going to need to buy in to continue to keep growing. And then more people. So it actually could be a self-fulfilling positive thing that happens as well. So we need to keep our eye on that. But for the fact that there's a lot of risk out there for what's happening, most likely we're going to see at least a lot of ups and downs and some of the sideways movement happening in the stock market. And we won't know, obviously, until some of these things start to get solved. But that's why we want to be invested a little bit into, well, money market accounts that provide all that flexibility and a very high interest rate today that we haven't seen in about a generation now. But we can also be invested into some other types of investments that provide some growth potential and guard against the risks while still maintaining the growth that could help us to keep going up if the stock market decides that they don't want anything to do with this risk management and trying to figure out the debt ceiling and everything else. They just want to continue to keep going up under the fear of missing out. So with that, we have a lot to do, but I just wanted to give you a highlight as to where we're at today. With that, take care.